Fertig is going to speak to you. He is a 1982 graduate of the University of Illinois Tau Delta chapter. Unfortunately, we're not here, but we're going to change that very soon. In 2012, so when you come back to convention in 2012, we will be back and we will be strong. Maury's he founded Relative Value Partners, which is an investment group right here in Chicago. He's the founding partner of that group. He spent 17 years working for Salomon Brothers and Citigroup, if I'm speaking correctly. A very, very accomplished financial person. Let's give it up for Maury Fertig.
Thank you, Dan, for that nice introduction. And if you see me looking over here at, just turn down just a little bit. Is that over here? No, the volume. On me? 1 second. Okay, that's better. And if you see me looking over here at Nick, he's going to be my clicker on the slide presentation. So you'll understand why I keep glancing over at him. But thank you so much for being here today, and it's an honor to be here, and I look forward to seeing you all this evening. And I have a few opening thoughts to share with you, a little bit of my background. I'll try not to be redundant with anything we'll talk about tonight, but it tends to tie things better a little bit with the overall theme of my presentation. So my objective is, a lot of you guys are, young. You're thinking about college and your careers, and investing is something right now for most of you way out in the future. And what I hope to accomplish this morning is leave you with a few takeaways, a few nuggets, a few things that 5, 10, 20 years from now, you remember somewhere you heard somebody say this. And that's really what, what you might walk away from. And at some point in your life, it might make a big deal for you in terms of your investments. And I can't emphasize how important this is for all of you as you go through life. One of the interesting story I wrote, when I wrote this book, one of my former colleagues from Salomon, who I wasn't very close with, he called me up. He had taken the book on vacation with him, and he was in Hawaii, and he read the whole book there and back. And he came back and he called me up and said, I read your book, and I just sold all my Citigroup stock in the beginning of 2007. And at the time, Citigroup stock was trading $50 a share. And most of us know, 2 years later, it traded $1 a share, and the government had to come in to provide capital, and now it's up to the lofty price of $4. But for him, it made a big difference in his lifestyle and his ability to leave there and to go on to do other things. And for many people, you don't know where it comes from or what the idea is, but there's a lot of sins out there that people commit when it comes to dealing with their finances. Emotions tend to play the part, and whatever I can do to provide a little bit of insight into that, I hope you find worthwhile. So I worked, as Dan said, I was working at Salomon Brothers. We became part of Citigroup Travelers. We became this financial behemoth, a bureaucratic mess, which was somewhat dysfunctional, as you can see from what happened a few years ago. And by 2002, I had been at the point where there really wasn't more for me to do in Chicago to either go to New York and keep doing what I was doing, and being part of that company, it wasn't nearly as interesting working there anymore. And I had been fortunately, I'd been a good investor and saver, and I was in a position to take some time off and reassess my life and my career and what I wanted to do in the second step. I was 42 years old. It was like, what am I going to do for the rest of my life? And I didn't want to stay there. So my kids were relatively young, 12, 10, and 8. Figured it'd be a good time. I could afford to take a couple years off, take a step back, figure out what I wanted to do, and spend some time with them. And so I did a lot of coaching. We did a lot of travel. It was wonderful, and one of the best things I've ever done. And I feel really blessed that I had the opportunity to do that. But come about the winter 2003, when the kids are back in school, it's January in Chicago, there wasn't as much great stuff to do outside, and I sat down at my computer one day, and I said, I have all these great stories, investment stories, about smart people doing really stupid things with their money. And I experienced that when I was at Salomon. And I saw a lot of smart people during the dot-com bubble and bust really take all the money they had worked for, in some cases 10, 20 years of working in the investment area, and getting swept up in this and really getting wiped out. which was a little side note. I mean, there were a lot of people that got wiped out, but to think you had people, I mean, these people that I worked with were bright. They went to the best schools. A lot of them had MBAs from great schools. These were no dummies. And they were advising, they were investment bankers, they were institutional traders, salespeople, dealing in very esoteric financial products, whether it's mortgage-backed securities or high-yield bonds, and they were experts in their particular area. But when it came to their personal money, they really were just like anybody else. They got into the hot thing, they got swept up in the emotions of the market and reacted poorly. So I had a lot of good stories from those days, and I figured I could turn this, maybe I could turn this into an article. One thing led to another, and I had this manuscript, I had a book, and had to change it a little bit to make it more marketable, and came up with the idea of putting them all into 7 different sins. Figuring if you could avoid these 7 sins, that's a big part. You're going to be ahead of most people in life when it comes to your investing. So put together a book proposal, and a couple publishing companies were interested in '05. They wanted a sample chapter, did that, got 1 offer, and the book was published in the summer of 2006. And that was very, very exciting for me to have that take place. So, just as a way of background, I think it's important that you understand what happened 10 years ago. Most of you, the undergrads, were very young and probably don't have any knowledge of it. The older people may have some knowledge of it. But 10 years ago, we had a horrendous bubble or bust in the market. And it was driven by a euphoria over the internet and this emerging technology. And if you go back to 1993, 1994, very few people, the internet existed, it was sort of not something that was mainstream. By the late 90s, it became, the most explosive, the thing of our generation. And anything associated with it was considered gold. You had companies merely with ideas that were internet-based that people were paying hundreds of millions, billions of dollars for. You had companies that had a couple $1 million in sales being sold for $1 billion. Insanity was taking place. And it swept up all areas of the financial markets. So anything with growth, with technology, with the internet, by 1999, you bought it, it went up, and it just kept going up. And that was basically the mantra, and everybody got swept up in it. It was the type of market where you could get a tip from your barber, from your cab driver, from the shoe shine guy. It didn't matter what it was, they all worked because everything went up. And everybody thought they were financial geniuses. I would say that most of the people I worked with had, other than maybe having some semblance of knowing what the company did, couldn't tell you what the sales were, couldn't tell you what the earnings were, couldn't tell you anything about the balance sheet, couldn't tell you about anything other than, oh, it's something on the internet. So that's it. But they'd go out and buy, they'd take $10,000, $20,000, $50,000 and buy these companies. And this went on all over the country. Today, 10 years later, a lot of these companies are still around and have done very well. And to give you an example of that, Cisco Systems, which really provides a lot of the backbone of the internet, it's a great idea, it was a great company, but a decade ago it traded for $81 a share. Today it's at $23. And it's making multiple times more money than it made 10 years ago. And you have the same story with Juniper Networks, traded at $244, it's at $28 today. Great company, doing much better than it did a decade ago. But people just got too worked up and too greedy and didn't really understand what was happening, but just kept buying and pushing prices up. Those are the better stories, money stories from that time. You have companies trading at 1% of their value. They've lost 99% of their value, or went completely bust in the years that followed. If you want to go to the next graph here. So this gives you a sense of the markets. This is the Nasdaq, and you can see it peaked at 5,000 in March of 2000, and we're still about not quite. We're down about 60% still from that level, and that's after some rallies we've had along the way. And hopefully in your lifetime it may get back there, but it's going to be that gives you a sense of the picture. This goes back all the way it's about a 20-year picture looking at right there. I'm going to go to the next slide, please. Okay. So, why should you care about investments? And I'll give you the biggest reason why you should care. Because the world has changed. And I'll tell you how the world's changed. A generation ago, certainly 2 generations ago, you didn't really have to care that much about investments because the world worked differently. We operated on a system. When you went to work for the government, you went to work for a company, your retirement and your benefits were provided by something called defined benefit plans. The defined benefit plan was where you worked for a company for 20 or 30 years and you were a certain age, you would retire with a certain percentage of your salary and you'd get that the rest of your life. So if you were making $100,000, you might get, and you worked there for 30 years, you might get $50,000 every year the rest of your life, no matter how long you lived. And the company was responsible for making sure they could generate enough earnings on the money they set aside for your retirement to provide that income for you. And if they didn't, they had to throw more money in. But you never had to worry about that. Because you knew, I'm there 20 years, boom, I'm going to get this retirement, I'm going to get this paycheck. And that's how it's worked in the municipalities and states. The whole country sort of operated under that premise. What's happened now is, certainly in private America, when you work for corporations now, that is going away. And certainly it's starting to go away in the state and government jobs where it was always existed, because it's very expensive to maintain that, and they figure, why should they take on the burden of providing this return to their employees? Let them do it themselves. And that's what that's what the world's turned it into, and that's called defined contribution plan. So all of you are most likely going to have to be responsible for saving money for your kids, for your kids' college, for things you like to do, and most certainly for your retirement. And it's going to be a problem for people that aren't prepared and that have no idea how to deal with it. Because even if you look at a spectacular decade like the 1990s from an investment perspective, there was a study done looking at returns, individual returns in the 1990s. The market was up about 10–11% per year for 10 years, which was a very good period of investment performance. And during that period, the average investor, based on this study, had returns of about 3% a year. Well, and I'd say at least they were positive, but the problem is investors, between fees and bad advice and getting in at the tops and selling at the bottoms, they ended up really not participating as fully as they really should have. And 3% returns, to build for your retirement is going to be very difficult to build wealth that way for 20 or 30 years out. So anyway, that's a little bit of background as to why I think it's why I think this is important for everybody. The other thing, other observation that I think will play out is, unfortunately, we've had, particularly in the 80s and 90s, we had a tremendous, we had very high bond yields, very high stock returns. We look today, the treasury yields are very low. The ability to get yield and return in the marketplace is very low, and I think we're going to be in a lower return environment for the foreseeable, potentially the next decade or so. So it's going to be all the more critical not to to be able to capture as much of that as possible. So okay. So why don't we get into some of the sins, and I'll just share with you that these sins have been around forever, and I'll cite one example. 1637 in Holland, the Dutch tulip bulb bubble. And what happened in 1637 was people, Dutch tulip bulbs, there was demand for the bulbs to make more flowers and export, and it became a mania. And people just kept buying, accumulating these and selling them, and they just kept going up in price. And people didn't buy them because of any intrinsic value, because they were worth that much. It was only because you expected to get paid more the next day. At the peak, one single flower bulb traded for equal to that of the wages of 10 skilled workers for a year. So put that in today's dollars, could be $250,000, $500,000, something that may have been worth $1 was trading for potentially $500,000, and then nobody wanted to pay that anymore, and there were no buyers, and the price fell apart, and fortunes were lost. And that was really, really a function of greed. And we've had that take place really going back in many cycles throughout time. And the reason I spent so much time talking about this .com bust was 10 years ago. we had periods like that in the 60s, obviously in the 20s, and we will probably experience something like that in something else in your lifetime. We saw that, to some degree, we saw that in real estate in this country, that just, in 2000, it peaked in 2007. So it always takes place. It's human nature. But if you can be aware of it and just conscious of it, I think you'll do yourself a good service. So let's talk about envy for a moment. So envy is when you make an investment or an idea only because your friend's doing it, and you kind of get swept up in the fact that, wow, he bought this stock and it doubled, and he thinks it's going to double again, and that would just really upset me if I didn't participate after him talking to me about the stock. Now the problem about these things are, you'll notice, you'll see this in life, people tend to talk about the good stuff. They tend to talk about the winners. They tend to talk about, so this colleague, let's say a work colleague, might have bought 10 stocks, 9 could have done nothing, 1 tripled. You're hearing about the one that tripled. You think he's a financial guru. So you buy the stock, you don't know what it does, you don't do your due diligence, you don't do any homework on it, but you buy it purely because he owns it. And you're concerned that you're not going to participate too. And I saw a lot of that go on where I worked. People would talk about their high flyers, and everybody would want to jump on board because they wouldn't want the train to leave without them. The next sin is vanity or pride. And this really has to do with admitting you're wrong. And I make investments all the time for my clients and for myself, and very often I'm wrong. And you're always going to be wrong in the investment area. Things change, circumstances change, companies change, earnings change, and you have to admit that. And if you can't admit it, what happens is you tend to potentially plow more money into your losers. You tend to fight things and never admitting you're wrong. I had one of my colleagues that sat with me back at Solomon around early 90s. This was a period where the market was very strong. The markets were very strong. And he would look, I think the market's going to go down, and he would just take his bonus and keep it in cash and do that every year and never do anything with it. And then the market did go down. And, well, I think the market's going to go lower. I'm not going to do anything. And then, of course, the market went up 30, 40, 50% over the next several years. Never did anything because he had an idea. He stuck to his guns, and he wouldn't admit that maybe circumstances changed or the valuations changed, and that ended up costing him a lot of money. So you got to admit you don't know everything, and you can't let your pride get in the way when you talk about investments. Here's a good one: lust, and you never thought it can apply to investments, but it can really. I'll share with you one real takeaway. This ties back to the story I told you about the colleague who was flying and reading my book on vacation. What happens with this can be lust for an investment style, lust for only buying penny stocks, lust for sitting in cash. But the real thing I'd say, message I try and leave you with is lust for your company's stock and falling in love with it and thinking and drinking the corporate Kool-Aid, if you will. And what you'll find in the corporate world is you'll have a lot of opportunities to participate in stock plans. So you may get a bonus in stock. There may be an ESOP where you can buy stock at a discount. So if you're at a company for a substantial period of time, all of a sudden a big part of your savings and net worth might end up being in this company's stock. Now, some of that stock is what they call restricted, and you can't sell it, and that's understandable. But a lot of it will roll off every year, and you can sell it. And what I tell people is never, ever keep more than 10% of your net worth in a single stock if you can avoid it, even if it's a company you work for. Because if you can sell it, you should diversify. And you look at people at Bear Stearns, AIG, Lehman, Fannie Mae, GM, all in these corporate plans, all had their net worth tied up in these stocks. People, particularly at places like Lehman, had 50, 60, 70, 80% of their net worth tied up in the stock, and some people never ever sold the share because they thought that was the corporate thing to do, and they were wiped out. And you don't know where it's going to come from, and I clearly saw it at Citigroup. Even though the company's still around, it's never getting back to 50. But you really need to you need to back away, and you need to think about diversification and think about yourself and your future, and not get too wrapped up in even if you do love your company and you think it's great, you don't need to put all your eggs in one basket. Okay, so this is probably one of the worst ones, and avarice or greed really comes down to trying to make too much money, not taking a profit, and thinking that you're smarter than everybody else, and you're gonna keep, and your investment really has no end in sight. I got a couple stories to share. I had in my first year when we started Relative Value Partners, I had a client, a man about 70 years old. He had a portfolio with us. He's probably worth about $50 million. This guy, so he's done very well over the years. He had about $5 million with our company. And one day, I think the market had been choppy for a few weeks. One day he calls up and says, "I'm pulling my money out." And we go, "Well, why? We've done a pretty good job, and what's wrong?" He says, "Well, I just met with Goldman Sachs, and they told me they have a hedge fund they can put me in, and I can make 30 to 40% a year." So we took the money out, moved it to Goldman Sachs Alpha hedge fund, forgot the specific name, but Alpha Risk. Ended up losing 30% the next year in that hedge fund. So there's a message there. Guy has $50 million. You don't need to make 30%. You need to make 6%. You don't need to make. It's an insane thing, and that gets down to greed. I sat with a fella right before I left. I left Citigroup in this was 2099. He sat with me all during the dot-com bubble, and I kind of watched all these people, and they were giddy, and they weren't working, and they were just trading their stocks, and they were all having fun and talking about retiring. And he sat with me, and I kind of explained why I think this is bad, and I was like the old fuddy-duddy, like, what's wrong with this guy? And he kind of believed me a little bit, and he got his biggest bonus of his life in January of 2000, and he sat with it for about a month, 5 weeks, and he couldn't take it anymore. And he piled all his money in a couple internet stocks in like March 1st. March 18th, March 10th was about the peak. It ended very badly for him. But I said to him, I remember saying to him, right around that time, I was buying, I was buying some bond fund or something. I said, if I could guarantee you a 10% return on your assets the rest of your life, what do you think of that? He looked at me like I was a lunatic. Like 10%? What would I want with 10%? When I can get 10% in an hour? Or 30% if I hold the stock for a week. That's the type of mentality. That's the type of greed that was out there. One more story that I think you'll appreciate because it ties in with somebody that wasn't greedy, and it's a very well-known Highlam alum, Mark Cuban. And just to share a little bit of his story, he wasn't greedy, and that's why we know who he is. So Mark Cuban started up a internet radio station, internet broadcasting, a company called Broadcast.com. It had revenue of $13 million in 1999, and Yahoo paid $5.7 billion for this. Now, part of that was they paid in Yahoo stock, which was also funny money, and a lot of people did deals in funny money stock, and they kept it because they wanted to get richer and richer and richer, and a lot of those stocks are either worthless or lost 99% of the value. Mark Cuban, smart guy, said, okay, I got half the company, so it's $2.8 billion, and you got to pay a little tax along the way. He bought puts, so he protected his down. Basically, a put allows him to sell the stock at a certain price if the market goes down. Well, the market collapsed. Yahoo today is worth 1/10 of what it was worth 10 years ago, and he walked away after taxes. He still had $2 billion, and that's why he bought the Dallas Mavericks, and that's why we know who he is. So here's a story of somebody that really wasn't greedy, knew what a good thing they had going, and walked away. And you can think for a lot of people, whether he had $2 billion or $3 billion, what the heck's the difference? So very very smart man. So one of the things that I would say again about greed, and you buy something and you believe in it. Just employ a position limit, a size limit in your portfolio. If it's 5% of your portfolio, you're not going to go to the poorhouse if it blows up on you. But always kind of keep that discipline in trying to be diversified. And I think if you do that, that's another tool that will help you along the way. Anger, wrath. This sin is not quite as frequently committed, but it's committed enough that it costs people money. And I had some examples in my book, but I'm going to bring you a much better example because it happened, I can think of two in the last, right now. Yesterday, Hewlett Packard, the CEO, Mark Hurd, came out that there were some sexual improprieties or some relationship with a contractor, and he's resigning. And the stock drops 11%. And they also reported good earnings, but the stock dropped 11% just like that. Now, again, somebody might react in anger, and or upset, like, oh my God, I own the stock, and look what happened. Take a step back. I'm pretty confident it won't be down. That 11% will be a bad sale for somebody in a few weeks. So I always say, if you get angry about something, if there's a downgrade or a bad earnings announcement, don't try and tend to overreact. The best example recently is BP, and I heard it and I saw people do it. BP stock traded at $60 a share before the oil disaster, and of course it's an environmental disaster. It's an awful thing that happened, but you have to separate the equity investment from what's happening in the Gulf in terms of what the valuation is. So if you had the stock and it was at $60, it lost over $100 billion in market cap. It traded at $27 last month. And that's because people got, I hate Tony Hayward. These guys stink. I can't believe what they're doing. They're knuckleheads. And again, I think a lot of people sold their stock in anger. And I had some prospects come in the last month, and they were upset because they were pulling their account from somebody because they had BP stock in it. So again, try not to let that influence what you're doing from an investment perspective. Gluttony. This has to deal with trading too much. People tend to trade too much, and the people that really get into it, and they do it irrespective of taxes and commissions. And what I've experienced with it is people who do a lot of it don't make any money. They're not getting anywhere, and they end up just sort of, it's like running on a treadmill. And then when you get periods where the market does better, they're not participating. So that tends to be a sin that I see it committed every now and then by people that are impatient. They get very impatient about their investments. And I caution that if you really like to trade and you're good at it, take 5 or 10% of your portfolio and trade it all you want and get a low-cost, low-commission broker, and it's not going to hurt you. But you can track your performance. Are you really making money? Are you really adding value? That's going to be fine. But if you take that with the bulk of your savings, I think that ultimately can be a problem for you. There was a study done by some professors from University of California in 1998. They looked at portfolios, I think it was Schwab portfolios, for a 6-year period in the early 90s. And they segregated the portfolio into about 100,000 portfolios. They segregated them into high turnover portfolios and low turnover portfolios. The low turnover portfolios had annual outperformance of the high turnover portfolios by 7.5% a year. So that's over that 6-year period, compounded, it's certainly well over 50, 60%. So it's a massive difference. So I just caution that trading too much and moving around and being impatient, it's a very long-term process. Sloth. This can take lots of forms. One is, in bad markets, not opening your statements because you don't want to see what's going on. Well, I know it's bad, I don't need to see it. This can also be not so much for the person that, you can be a thoughtful person and hire a manager, like me or anybody else, and not monitoring what they're doing and not watching their performance. That can be slothful as well, because you've given them responsibility, but you're not really, you kind of look at your statement, but you don't really know what they're doing or how they're doing. So I caution people that outsource their money and don't do it themselves, which is fine, that they monitor their advisors or brokers or whoever they're giving them money to against the benchmark and know how they're doing. I had a story about a friend of mine a few years ago. I asked him, we're just talking and we talked about investments. I said, how's it going this year? He said, going really well. And I said, oh, wow, good. This was 2006. And I said, well, how are you doing? He said, I think I'm up like 8%. And he had a stock portfolio. And I said, wow, it doesn't sound that good. The market's up 16. So he had no clue. And that's a big difference. You don't get a lot of years where the market's up 16. You got to take it. You can't take 8 when the market's up 16, because when the market's down 16, it's going to be pretty. It's not going to be that pretty. So you have to take it when you can get it. and really be on top of people that are, and there's a lot of people too that they'll be in a 401k and they'll put the money, oh, okay, the markets are rocky, I'm just gonna put it all in the money market option, and they just don't pay attention, they don't look at it, they don't realize until they hear on the news, the market's hit a new high for the year and it's up 25%, and go, oh, now maybe I should look at it. So try and pay attention. You don't have to monitor every day. You don't have to be a portfolio manager. You just have to be conscious of it. And a lot of people just sort of, out of sight, out of mind. So these are just some things that were in the book, little summaries of thou shalt not covet thy neighbor's investments. Again, dealing with envy. Thou shalt not make a killing, being too greedy. Know thy investments better than thou know thyself. Well, just kind of know what they are. You don't have to know better than yourself, but know them. Try and have a sense of what they are. Thou shalt not make unto thee a graven image of profits. Profits are, when I think about investments, I don't think about profits because you're building a portfolio, you're building long-term value, you're not trying to generate profits because profits are something a company does. You're building something for the long term. Thou shalt not take the name of the Lord in vain or issue any foul-tempered oaths while investing. Yeah, don't get too excited. It's funny. Thou shalt not commit adultery chasing some flashy little stock of the moment. Stay away from the high flyers. Honor thy mother, thy father, and make the market in good times and bad. So don't give up on the market when it's bad. We'll talk about that in my conclusion here. Thou shalt not steal from thyself by forgetting about taxes. Always important. Going to be more important with all these new taxes that are kicking in 2013 on investment income and with the change in with the changes in potentially in taxes coming up. So always critical, short-term, long-term gain. So it pays to always, if you're dealing outside of if you're in your 401k, your IRA, a 529 plan, it's not an issue, but certainly with outside investments. Thou shalt not worship false idols or deceitful financial advisors. Just be on top of them. Thou shalt remain humble before the almighty market. Never think you're smarter than the market. Never think you're better than them. Never think you've got the thing figured out. Because when you do that, that's when it all comes crumbling down on you. Even Warren Buffett knows he's not smarter than the market and respects the market. So I try and live by that. I wanted to kind of wrap up with some specific messages that would be a good takeaway for somebody when you're starting out, if you're starting out with a 401k, you're starting out in the investment, to have some money for investments down the road, and just some things to think about. I believe that when I look out 10 or 20 years, I believe equities will be a better place, stocks will be a better place to be than buying bonds at this point in time, or putting your money in cash or a CD at 1%. That being said, these things don't move in a straight line. The market never moves in a straight line, and it can be awfully painful along the way. But when you look at I would encourage you to have a meaningful, when you begin, have a meaningful equity exposure, particularly at a young age. And I'm a very big fan of using low cost index funds. You don't need to find a fancy manager, but that's a good way to start. Never pay a sales load. A lot of people sell funds and they charge 5% up front. And I'm also a big fan of dollar cost averaging. Dollar cost averaging simply is you're taking $100 and you're investing it every month, no matter what's happening. And when you put that $100 in the market, the great thing about it is when the market's depressed, you're buying more stocks, essentially, because the prices are lower. And when it's higher, you're buying less. So it allows you to essentially, if the market just kind of goes like this, at least you're putting more in at the lower prices. So if you think about what we've been through in 2008 and 2009, and a lot of people backed away from investing, people that were putting their money in their 401ks and backed away because Kramer told them to in October 2008, and they didn't invest, and they stepped away, and things were horrible. The economy was horrible in February and March of 2009. You couldn't draw a worse picture. But the markets rallied 80% from March 2009 to April 2010. It's since come off a little. But if you had been sticking with that discipline, even right after the Lehman bankruptcy, and doing your dollar cost averaging, all those investments would be worth a lot more today. So it tends to be, you can't overthink the market, and just when things are bad, that tends to be the right time to invest. It's very contrarian, it's not intuitive, and it's very difficult. And if you're on a program where you're doing something like a dollar cost averaging and you leave it alone, it's hard to mess up. So that's just one of the messages I want to leave you with. And this is a quote that I really love, and it really kind of summarizes the last year or so. Bull markets are born on pessimism. There was a lot of pessimism in March of '09. They grow on skepticism, and I remember all through the summer and fall of last year, turn on CNBC, oh, this market's gone too far too fast, blah, blah, blah. Mature on optimism. People get, okay, things are pretty good now. Okay, I'll buy in, and the market goes higher. And then finally die on euphoria. And I remember April 23rd of this year, we hit a high in the market. And the New York Times, recession's over, economy's booming. People are talking about what is the Fed going to do to slow the economy down, because it's getting too steamy, and people, and lo and behold, after all this euphoria, people start to put money in stocks, and a few bad pieces of economic news break in May, and we dropped a quick 15%. So certainly had it before. Hopefully we're not, that was one bull market. There's going to be many in the future, but that just characterizes what we go through, and just something that John Templeton, a famous investor, said many years ago, and something that I've found very, very true and think about very often when I'm investing. And that's anyway. That's about the end of my formal presentation. If you like what you heard, you can see me. I'm going to be on CNBC on August 26th at 10:15 Eastern on Squawk on the Street, talking about some investment stuff. They won't give me this much time though. It'll be like 3 minutes, but it's okay. And anyway, I thank you for, you've been a good audience, and I think we have a few minutes we'll take some questions.
What do you, I don't know if you know this particular stock, but I just invested 5 shares in it. What do you foresee happening to Chesapeake Energy?
I know that it's very much tied to, it's a natural gas. It had some real problems in '08 because of, they had a lot of debt that was due. I know the stock's gone up a lot from then, but it's still, from what I know about it, I think it's okay, but I can't speak specifically. I think it's what, $22 or something?
22, 23.
Yeah.
Yeah,
I can't speak specific at the valuation, but I like that space. I like natural gas, and they've gotten over their debt issues. They've refinanced a lot of that, so it's not a problem for them anymore.
What do you think's a healthy amount of time every day you should devote towards, I guess, managing yourself?
I don't think you need to spend time. I don't think for the average person you spend any time, on a daily basis. That may be too much. You got two types of people. You got people that are going to want to, that really are fascinated by this and want to spend time on individual stocks, and that's a different area. And there might take a little time every day if you really, if it's something you're passionate about and you like. If for most people, it's going to be a function of doing, looking at your monthly allocation, and really, I think if the average person spent 15 minutes a month, they'd be in good shape, because the average person spends no time. They maybe open their statement, oh, good, bad, okay, on to the next thing. So I don't think it requires a lot of time. It just requires some focus.
I'm sorry to hear the back.
Oh.
If you got questions, I'm gonna run the mic.
Great.
What avenue or what
Here,
wait, Cal.
Where would you say that we should, if we did have money, or where would you refer us to go to invest? What department, what area?
Well,
good stuff.
if it's all a question of if if you want to focus on individual stocks and put the energy in and do that, that's one story. I think that's okay, and you can learn and open up a brokerage account at a place like Fidelity or Schwab, where you don't pay, the commissions are very low, and do the research, and you can buy some things if you have discretionary money. If you don't really want to put the energy into focusing on individual stocks, I would just recommend a series of low-cost index funds that all these places have. The fees are next to nothing. You can buy an S&P 500 fund. You can buy. I would diversify. I'd put a small amount. I might put a small amount into high yield bonds, just to give you a little stability and cash flow. But most of it I put into emerging markets. I put into a growth stock portfolio. I put into the S&P 500. And again, if let's say you had $10,000 today, and then you're sitting on it. I wouldn't do it all at once, and I wouldn't do it all, maybe I do, I put 1,000 in a month. So at least, we're always sort of in uncertain times, and you hate to put it all in at the wrong time, or put it all in one shot and get one cost. But if you average it in, the odds of getting in, smoothing your entry points, I think is better. And I would operate like that.
So when you
I wouldn't say.
So when's a good time to sell then?
Well, a good time to sell would have been a period, if you think about, certainly 99 is a great time to sell. September 5th, 2008. But just in all seriousness, there are points where, where the market has periods of, let's say you have a portfolio. Let's say that, you're young guys, you're gonna build a portfolio. It's gonna be 80% stocks, 20% bonds. So aggressive portfolio, which is fine, at a younger age. So you will have this portfolio. The market's rallied quite a bit. Now your portfolio is 90% stocks, or 90 because the market's rallied. That's when you wanna, you wanna look at it on a monthly or quarterly basis. That's when you wanna rebalance, bring it back down. That's how I would operate in just a simple terms. Just if you have an allocation, and same thing the opposite way. The market's gotten killed. Look at it. Maybe you shift some money from cash or bonds to buy stocks after they've been depressed. But it's hard to know when things have run too far. And people, you could have said that about this recent rally when it was up 40%. Oh, people were saying that. But at that point, if your equities had grown as a bigger percentage of your portfolio, you trim back a little bit, and you trim as it goes up, and that way you're still participating and making money, but you protect some downside.
I'm just curious what industries you think are the strongest and fastest growing, where the best areas are to invest in.
Well, the interesting thing when you say strongest and fastest growing, sometimes that can be the valuations aren't as attractive. I'm a big believer of I think as the world is shrinking, as I was seeing the people in China and India, all of a sudden people are getting cars, and 10, 20 years ago people didn't have cars there. I mean it's a new phenomena, and people are using more energy, and our energy consumption is this, and in China it's this, in India it's this, and they're not going to equilibrium, but there's a lot more people there, and as theirs comes up, the demand for energy is going to increase. And I'm a big proponent of having a meaningful. I think energy is going to be a more precious commodity energy materials, things related to the food commodities, all the things that the world sort of needs as it gets more, as we have more people and more and people come up from the lower class and get more interested in other things. So I think those are good areas. The valuations aren't bad. So I tend to like those sectors right now. The technology sector is actually reasonably cheap. You look at companies like Intel trading at 10 times earnings. I mean, this is a company that they are the leader in certainly in the microprocessors and continue to make great advancements. It has a dividend yield of 3%. So the technology is always is a good place to be, much more so than it was certainly many years ago, and the valuations are extremely attractive there as well. Yeah. Yeah.
That was so easy.
I know.
What do you think in regards to having cash value life insurance as a risk-free asset?
Good question. I think it's great. The only problem with cash value life insurance is you have to look at that as a really long-term investment. And if you do, I have a policy I took out in 1985 in Northwestern Mutual, and I ran a return analysis on it. I think it's like 8.5%, 9% annualized, which it's tax. There's no tax on it either. That's been a great investment. So I think for the right insurance, you want to be with a very strong carrier, and if you look at it and it's possibly a 5 or 10 year investment, it doesn't work because the commissions are very high up front and the sales charges. but over time, those smooth out. So if you look at it for 20, 30, 40, lifetime investment, which I have, I think it's okay, again, as part of a diversified approach to investing, absolutely. And the tax benefits are phenomenal too. Do you sell insurance?
I am with Northwestern.
Are you really? Okay, wow. Very good, yeah. Very happy with my policy.
I've actually got one for you, Maurice. If some of these guys are obviously sophisticated and have a pretty good clue what's going on, for those who aren't as sophisticated, aren't familiar with stocks, is there anything they can do now, if they don't have any money to invest, like a fake portfolio or something like that? Is there something they can do to get themselves familiar?
Yeah, that's a great idea. If you want to get into it, you can set up portfolios on a lot of websites. Yahoo Finance is one I've used. You can set up a portfolio with sizes and do trades and see how you do and track things, and you get news alerts. I mean, the tools available now that weren't there a decade ago are really, really great, because in terms of getting information and knowing when earnings come out. So that's a nice idea if you have an interest and potentially a passion, or maybe it's a business you want to get into, which it's a great business if you have if you like working with people and investments. So I think I think that's a good way good approach to take. There's a lot of books to read. You read mine, but there's many books out there.
Anybody else? Going once, going twice? Sold.
Okay, well, thank you. Thank you. You've been a great audience, and this is the first time I've ever done this, and I really enjoyed the opportunity of speaking to you. And I hope, as I said, I hope you have a couple nuggets that I leave you with, you remember at some point in life, and I really look forward to seeing all of you tonight.
Thank you.